here's what I'm going to do. I'm going to start from scratch. So right now, you know, this is what's going on in the market. We've actually seen a lot of momentum happen here. As you guys have heard over the last couple of weeks, there has been trillions of dollars that's been injected into the market. So we have been seeing this recovery over the last couple of weeks, right? We've been seeing this bullishness. So right now, we're noticing that we have that imbalance. Remember, imbalance is essentially a lot of money coming into the market, allowing it to move without the normal pullbacks, right? The market is supposed to do something like this, right? That definitely didn't happen here, right? We just saw all of this money come in. And remember that the institutions will always sell to buy, and then they have the sell position open here in drawdown. So right now we're actually seeing that position in drawdown. And so at some point the market's going to come back into here to close out this institutional sell. It's an open position, and then from here we have a better place to buy. But right now the only thing I'm making you aware of is that there's an imbalance here, clearly. Market is pushing down pretty aggressively right now. So I'm going to talk about this trade right here in a bit, but I'm going to walk over what has just happened over the last couple hours so it makes sense to you. So we have in this area, you notice how it's a pretty, you notice how over here you have a lot of just normal support. A lot of people would be buying in this range due to what's been taught on baby pips and all that other trash. So you have just a normal buying and buying and buying over here. And we call that liquidity. There's because you have a lot of retail entries loading up in there. So beneath that are the stop losses, are all of these retail stop losses. And you notice that the market then decides to push down, clears out these stop losses here, all this stuff here, right? If I go into an even smaller time frame, 1 minute or the 5 minute, we'll notice, you'll actually notice that the market then comes back over here again, gives us these buys, retail buying, people are buying, look at this double bottom, people buy again, comes back, look at this triple bottom, people buy again, and then they finally get stopped out. So here are all the stop losses, and then you'll notice that this is where the market pushed down to take out all of these retail buyers. Remember, the retail is just the 99% that have been taught the wrong way, that mostly don't just even know that there's another game being played. So then this is that drop, which means that here is the potential mitigation. And here's the mitigation, which means that this is where the market's in drawdown. Institutions are in drawdown here. You see it all. Here's the imbalance. So market needs to come back and clean this up. Close out these institutional sells so they can keep going up. Here's what we call imbalance. Right there. Right there. Imbalance is easy. It's just momentum that never really got the pullback, that the necessary pullback. And then you actually see this drops and then again just pushes up. So even if I hop onto a 15-second here, you'll notice, see, look at this. This is not normal, guys. The market isn't supposed to just melt and then explode and then this little baby pullback. That no, that's not enough. Right? You need at least going at least halfway, and more than anything, you need this to be closing out these sells. So I personally am a big fan of taking trades back inside of the imbalance, anywhere from 50% and beyond. And then here we see all of this previous support, price action. There's great places to take trades. Would be right over here. So I'm gonna send, and what I do is I measure the initial imbalance. So here is where the market popped up, and if you noticed, it hasn't gotten back to this 50%, and this 50% is also aligned with all this previous support. So this is right here the first entry that we would be targeting. And then here's where you can, then the rest of it, you know, we like to take these trades between 50 and 886. More so 70, 1 and 886, but since we have the last point of supply in this range, and you have this 50% right there, I think this is a good spot to take a setup. All right, so here's what we're looking for a buy. Now let's talk about possible sells. So here's the buy just because of the way this is moved. Now we are a little far away from that, right? But now you know that it's there. Here's an imbalance. Another thing that I want you guys to realize and to notice is that the market here did something very similar again. So you have actually a couple spots right here. You have again support. Look at this, guys. Same thing happens. Liquidity, drop, pushes away, no pullbacks. So here's the thing. The more liquidity you have, the better the bounce you'll more likely get. We have some good, decent liquidity here, and then the market drops. Here's where you can see the market actually starts to drop. Right here. From right here, it starts to fall. So I'm going to take this right there. Here's the last point of supply. Here's that. And then look what happens. Then it just dips out. Pops up. People see this little doji, right? This is that death doji. Because people see this, people go crazy. People wilding out when they see this because they see something like that. I need to save that little meme on my computer because that's so funny every time. This doji, people start selling and selling and selling because they have all this liquidity here. And then the next candle, oh no, uh-oh. It's testing that resistance. And she gone. So this is a place where I can definitely see some entries coming in a bit over here. Now here's the thing. If I'm going to trade off of something like this, we didn't have like too much liquidity. There's maybe, 5-6 minutes of liquidity building up. It drops, then creates more imbalance. So when the market gets into this range, as soon as I see a healthy bounce, what does that mean? You'll start to see a certain kind of candle. So you see how this is doing these sort of candles here, tiny, small candles, and then you see a much bigger one. So once I see that larger candle, you can tell that there's more money coming in than there was previously. That's the institutions getting in. So as soon as that happens is when I would adjust my stop loss to break even. All right, so now let's go to the present. So what did we just see happen over here? We had some liquidity, market booms, stalls off for a little bit, one last push, and then it starts dropping again. So we saw liquidity, liquidity, liquidity. Honestly, it left some equal highs here. So the market will more than likely come and target up here. So even though, yeah, you know, we saw a nice little push up here and then this imbalance, this just is clearing equal highs right now. So what I like to do, guys, is I'm teaching you while I'm giving you setups. All right, and I'm gonna keep showing you things that are happening and why they're happening. Like liquidity here, the reason price is being driven up here is so that this gets taken out. Now here is imbalance. Remember, market's supposed to do more of this choppiness instead of just the melting like that. So here the market was rejecting for a little bit, pushed up, then dropped. Maybe, but none of these trades are really worth it because we don't have those higher confirmations. So I would stay away from anything inside of this right now. But now we went over the buy, which looks nice over here. And then this could be a trade that you take, but I wouldn't hold this or swing this. Right. You guys see how here it accumulated a lot more money and then made its move. Here it was a lot less, there's a lot less liquidity. So could the market bounce off of this? For sure. But this isn't something that I'm going to just look to hold. It could push up nice and, you could hold it for a couple 100 points. But this is something that I would protect myself as soon as I get a healthy bounce away from it. Plus, it's a less than a 50-point stop loss. So you're in a good spot. We'll go into the sell because I like the sell better than I like even these. This is a good trade. This is a good trade. All right, and then somewhere in here is a better spot too. But the sell position is just this one's a lot cleaner. And then I'm gonna walk you guys through this one. So, during the bounce back session, Zachary was saying we really don't have anything to trade right now. And he's right, right? In the price action that we were in, we weren't really looking at anything. Nothing was very relevant. So when you have moments like this where you're at, highs compared to the last, month, 2 months, what I like to do is I go back and I'm like, okay, well, I have to look left because these banks are always leaving some clues. They're always leaving a little something in the back. And so when I went back here, I'll hop over to the 1 hour so it's more clearly. But when I went back, I'm looking at, okay, well, where do I have imbalance? Where do I have the market? Where does it just trend and just pretty much disappear? But you have this huge imbalance here. And then as I'm looking, I see, okay, look, it's choppy, choppy, choppy. Goes up, wicks, and then just drops. I'm like, okay. So there's definitely some imbalance in here. See how this just kind of melts away before any pullbacks. So that when I see this, here's where like, okay, now I'm gonna pay attention to here. I want to see what happened over here. So here's where I use the bar replay tool. And I take it to here. So this was March 11th. And then from here, I start coming down to different time frames. Okay, now I'm narrowing down. Remember, every time frame you go down to, it's for detail. It's so that we get the detail. From there, you guys start to notice you have these equal highs here. That means liquidity. That means that there is retail. There's masses getting into sells here. See? There's the liquidity. I'll draw that fib out in a little bit. Here's the liquidity. Okay, but you guys notice how this still just dropped here with no real pullback? Just that baby pullback right here. Yeah, so there's still money left over here. Banks need to get in here. And then you had, remember the order, right? Identify structure, clearly bearish. Then you identify liquidity. Hey, well, there's liquidity. Then we see the institutional movement. Let's walk our way a bit down a little more, get more detail here. You guys see this bullish push, 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 push. Okay. Here's the imbalance. Market just drops, no pullbacks, and then just equal highs, comes back to these equal highs again. So you still have this space here where the market needs to pull back to. So what we want to do now is that we're looking for where did the institutional movement really begin? So that's what we're finding right now. Okay, where does the institutional movement begin? Because if we look at it like this, here's where we notice the market really start to push up. And then remember, look at these wicks. This is that resistance. Here's where most people are getting into sells, the 99%. And then you have the 1 minute time frame. And then now that we're here, you have liquidity, rejects. Most people here at this point, they keep seeing the market slow down there. Right, here's where people start seeing it reject. Oh, look, a engulfing candle. So the way the banks have showed you and they've guided you into thinking, okay, this needs to drop. This needs to drop because it's the more times it rejects, people have been taught that it's supposed to fall. However, it's the opposite, because that means that there's more retail money in here. And so now that there's enough money, once there's enough money, then the institutions do that thing. Uh-oh. Shoots up. And then it does this. So we can tell that this is that move that really pushes the market up before it all melts away. So then this is the institutional move before it drops. So here's where it begins. So that's why I drew out this mitigation right there. And then you guys will see the market then start to create liquidity right here. And then it continues and it goes away. So here, there's more cells still waiting in here. Meanwhile, there's all this just drops, just this imbalance. So what I do now from here, you've learned, here's the institutional push up that's cleared out liquidity. So here's a buy position that's open for these banks. It's in drawdown this whole time. The fact that there's liquidity left over here gives us a good indication that it's going to come back and clear this out as well. And so from here, I like to measure from the high to where it starts to create the imbalance. So you see that? This push here. And then where I take my trades is anywhere between 71 and 886. And then a lot of times you'll see that it's in correlation with this last point of supply over here. You see, here's where you see this previous retail resistance. This is where I like to take my trades, in this range. So the best, at least the secure trade, that where you will lock in some profits, right? Or where you will secure an entry so you don't miss the trade, would be at this point where this push begins, because remember the price needs to get back to here for the banks to close out their buy, and then open up money for the sell. But you can narrow down your stop loss by bringing it back to somewhere up here where we've seen this retail position, this retail resistance before this last point of supply. So anywhere in here you have a better entry. I'd say you can take it to 24 150 right over here. Let's say even 24 140, 24 140, and then you have a great place to trade inside of, and then now your stop's a bit tighter, right? So this is what I'm looking for. This is my area of interest right over here to the present time. So what you want to do is you want to set an alert before the market gets there so that you don't miss the trade. Market builds liquidity. This is market acting a fool, right? Okay. So what happens is liquidity is built. Liquidity here. All right, liquidity on both sides. Cool. Now here's what happens. Either for the institutional money comes up or it comes down. So I just walked you guys through sells and buys. So either way. So let's say the market then does this. The market, remember, it's it'll do something like this probably. Something like that. And then boom, you have that push. So this right here. This right here. This movement that takes out everybody else. Wait, hold up. Oh, that's so sick. Why have I never thought about that? Institutional movement. Oh, that's nice. Okay. I'll make this a little bigger. All right, cool. There's your institutional move. From here, once this happens, then the market creates the imbalance. And it drops like crazy, right? All of a sudden it drops like crazy, no pullbacks. Market is wilding out, right? So then here you have imbalance. No, I don't like that one. All right. So once that happens, the market needs to come back, right? The market needs to come back to where the institutional move began, because this is where there's buy positions open. Here where banks buy, up here, right there, boom, banks bought, they're in. So this whole time they're in drawdown. So then the market will pull back. So at least here, it can go further for sure. You got a pullback here. And then you got right here. Hold up. because here's where you have mitigation right there. So mitigation is when the market comes back, right, and recovers to this place. Now the banks can close out their entry at break even, or they can close this out maybe in profits over here, right? But this is at least the minimum where the market needs to come back to before it can continue. So then here you have from here. And here you have the continuation. Post mitigation. So pretty much here's where institutions so here's the sell. Here you go. I hope this helps. I feel like this is a good example. I'm actually gonna change this up. So sometimes what happens is you see this is happening on the 4-hour, and then in here you see the same thing happen in the miniature mode. So you see, let's say this is the 4-hour time frame. Then if we were to zoom into here, we would see literally the same thing happen, but on a super tiny, like on a 5-minute or a 1-minute or a 15. You know what I mean? And so this tends to happen. This is like pretty much the Wyckoff kind of looks like this too, right? And so if you're in a downtrend and something like this happens, this is obviously you're just following the structure, so you can hold this sell for a lot longer. But if you're going against the trend with one of these trades, that's where you want to protect your entry a lot more, maybe more quickly, and take your profits, to a more, I guess, probable take profit, because at this point what happens is, and the crazy thing is that in this pullback here, you'll see this exact play out, right? But if you're going against the trend with a trade like this, that's where you target sometimes either the equal lows, where you start to see, consolidation or accumulation over here, and then what happens is that could happen. But if this happened, the same setup happened, but for the buy instead of the sell, so let's say you had the same thing but inverted, then you could take your profits, at the imbalance where it's filling in and mitigating down here. Do you know what I mean? So you can take profits at the mitigation, maybe the equal lows, or if you're following the trend on a bigger time frame, then ride it out using your Fibonacci. How long have I been trading? 3.5 years at this point. Yeah, a little more than 3.5 years. All right, yeah, I got you guys. I feel like the writing on this one is different. Come on. Show text. Why does this one look weird? Is that just me? It looks like different font to me. Oh, it's because it's array. How would they do that? Whatever. Yeah, I can actually print this out. But honestly, guys, the biggest mentor has always been the chart itself and your awareness when you're on the charts. Because there's a lot of things that you just learn based off of what you see. Like, for example, no one has ever taught me how to trade off of this. Like no one ever taught me, okay, here's the last points of supply. After mitigation comes in, this is a super highly probable setup that it comes back into this range, right? Even beyond mitigation, or like, we were looking over here, right? Like for this sell over here, there are things that people, not that they won't teach you, but they just don't know. Like there's things in Fibonacci that exactly no one has taught me before, but it's just been market behavior, studying the market and things like that. But like something like this, or we looked at this in the original sell, like trading off of this here where we've seen the market reject consistently price action strong here prior to the institutional move, you have a very, very good chance the market comes higher than the mitigation to here and then drop. What does that do? That makes your risk to reward way better, right? That gives you way less drawdown. So there's a lot of things that you'll pick up for yourself. Like for example, market structure was something that I think I have a different perspective on than people. So yeah, it's cool, guys. Take this information, and the most important thing behind everything is don't take my word for it. Go do it. Go look for it. Go mark it up. Do it again and again and again and again and again.